Last year was tough for apparel companies. With the pandemic forcing limited retail operations, Levi saw its sales fall 23% and its operating income fall 115%. Fortunately, its management did an excellent job navigating the company through the pandemic. One of the key objectives was making sure the company had adequate liquidity to meet its short-term needs. The company borrowed $500 million early on and suspended its quarterly dividend in order to maintain more cash on hand. Additionally, management focused on growing the company's e-commerce sales to compensate for its closed stores. As a result, the company has momentum going into the post-pandemic era. Now, before we start, if you enjoyed the content, please consider hitting the subscribe button. Not only does it help out a ton, I also very much appreciate it. With that said, let's begin. In the latest earnings report, the company beat both sales and profit expectations. Quarterly sales soared 156% year over year, driven by strength in the US and China. Interestingly, revenue in these countries also exceeded revenue in the same quarter 2 years ago, before the pandemic. Operating income was $107 million, up from an operating loss from a year ago. Management attributed the increase to higher net revenue and gross margin and the $242 million in charges a year ago associated with the pandemic. While the company had a fantastic quarter, the caveat to this earnings report is that Levi was facing an easy year-over-year comparable because of the pandemic. Its total revenue in this quarter still fell short of its revenue 2 years ago just by 3%. Some investors worry whether the profit spike will stay after consumer demand settles back down to normal. I'm in the opinion that the company still has plenty of room to grow. During the earnings call with investors, management implied that Levi isn't just experiencing a temporary boom in growth, but can achieve sustainable, stronger growth going forward. The company's strategy includes shifting toward direct-to-consumer sales, lowering expenses and inventory levels, and capitalizing on a growing sales footprint. Management also believes that the company is winning a more premium space in the industry, which should help it raise prices over time. When I valued this company in April, I calculated a higher fair value than the trading price at the time. Despite a setback last year, I believe that the company will persevere through the pandemic and capitalize on the economic bounce back as economies recover. The latest earnings report reinforces my story for the company. Therefore, I expect a double-digit revenue growth in the coming year as economies fully recover from the pandemic and operating margins revert back to pre-pandemic levels over the next 2 years. Afterwards, Levi will continue to capitalize on its iconic brand name to produce moderate growth through global expansion and product development. Its brand name will allow the company to maintain a solid operating margins that's higher than the industry average. Based on my story for Levi, I calculated a fair value per share of $33.40 on July 9th. The trading price at the time was $26.65 per share, therefore the company was about 20% undervalued. I decided to pick up a couple more shares since I saw a 25% upside. With that being said, that's all I have for you today. Make sure to like the video, subscribe to the channel, and comment down below where you think the company should be valued. Thanks for watching, and I will see you all next time.